All right. Good evening, everybody. Good evening. Thank you very much for joining the Wealth Mindset and Real Estate Investing virtual meetup. I'm the host, Chris Price of this meetup, and I'm also the managing partner at Boost Capital Group and the CEO and co-founder of Red Fox Multifamily. Before we get into today's topic, where I'll be covering unlocking wealth through passive real estate investing, I want to review a little bit about what sponsors this meetup. So first off, the Wealth Mindset and Real Estate Investing meetup is open to all who are interested in growing generational wealth through passive real estate investing and increasing their financial intelligence. This meetup is for busy professionals and retirees across various industries. The individuals in the group make a good living and have discretionary income to invest in real estate for its proven wealth building ability and power, but don't have the time, skill set, or network to do it at speed and at scale. This meetup focuses on helping us all grow our wealth mindset by learning how to build and preserve wealth while developing and maintaining an abundance mindset. This meetup will focus on multifamily real estate investing as well as other proven ways to build wealth through real estate through passive investments. We are sponsored by Red Fox Multifamily. Red Fox Multifamily helps pharmaceutical and life science industry professionals diversify portfolios, add passive income, and get all the other perks of real estate investing without having to do any of the work themselves. Red Fox Multifamily partners with passive investors to buy commercial multifamily real estate based on vetted opportunities we get access to from our trusted network of top operators in the best markets throughout the country. Partnering with Red Fox Multifamily makes investing in real estate completely hands-off, allowing investors to add passive income, build equity, and save on taxes, all while being an investment vehicle that's backed by a hard asset. And we are also sponsored by Boost Capital Group. Boost Capital Group's vision is to become the premier partner for busy professionals and entrepreneurs seeking to build and preserve their wealth through passive real estate investments. That this material does not constitute an offer or a solicitation to purchase securities. This is for information purposes only and should not be construed as business, financial, or legal advice. And what I also want to make sure that is that I really enjoy connecting with people. This is a great space. Want to be able to connect with you. If you're interested to connect with me live, please shoot me an email, chris@boostmycapital.com, or scan the QR code. You'll be able to access some other ways to connect with me. Follow me on social media. I'm very active on LinkedIn, Instagram, and Facebook. Please feel free to reach out to me there. Look forward to connecting with you and learning more about you and what your interests are as it relates to investing and building wealth. And so tonight, just go through really the presentation and the details of what we're talking about tonight. And then as time permits, we'll make sure that we allow for time on for some Q&A as needed and some virtual networking. So let me jump right into the presentation to say we're right now at the time of this recording, we're in early April of 2025, mid-April of 2025, more or less. And things have been very busy over the past few months at opening to the year. And I found it really important for us to take a little bit of time to be able to talk a little bit about this and put things in context from through my point of view and share a little bit about with you all so that you can get a sense of where we're going. But all of this volatility and what's going on here really has a lot of people concerned from an investment standpoint around what's safe. We've seen huge stock market swings, some of the largest in history as a result of policy just in the past few weeks. We've seen a number of other geopolitical things that are going on, local things going on within the United States, a host of other policy related things that could impact people's future. And I wanted to take a time today to talk a little bit about what are some of the things that we're doing that I'm doing specifically to make sure that people to understand how to refocus and reframe the situation and make sure that they're on the winning side of things when they're navigating through how this period, this next few years transition. But the time starts now to really educate yourself. You all know that real estate has been, has long been a powerful wealth building tool, but the active management required has kept many people from fully benefiting from this. Passive real estate investing provides a way to tap into the growth and stability of the real estate market without the hassle of being a landlord. And through passive investments like real estate syndications, for example, you can diversify your portfolio and generate reliable income to support your retirement. These passive strategies that I'm going to share tonight allow you to benefit from real estate's potential for appreciation and cash flow while leaving the day-to-day management to the professionals. So by essentially allocating a portion of your portfolio that you have to passive real estate investments, you can build wealth, protect against inflation, and create more secure financial future. So let's talk a little bit about in some more detail. But before we get on into all of that, let me go into more around navigating this current economic uncertainty in 2025. So the economic outlook for 2025 is actually very highly uncertain. Their latest reports have suggested that there's a 65% chance of a recession as a result of how things are progressing along just within the past few weeks. And different financial economists and such are really predicting that a recession is looming if we keep on the trajectory that we're on. Recent tariffs have been increasing inflation, putting pressure on consumer spending and business profits. Market conditions are extremely volatile, as you've all read, heard, and they can be pretty unpredictable as we've seen now and we've seen in the past. So it makes it challenging for companies and investors in particular to be able to plan ahead and be thoughtful about what it is that they're doing. It's critical for businesses to closely monitor economic indicators, stay agile, and contingency plans in place to navigate these turbulent times. And while businesses do this, we as investors and individuals need to be leveraging these principles as well in terms of being able to really thoughtfully plan and navigate through things. In this chart, I wanted to be able to frame this a little bit about what's going on here. So inflation has been steadily rising over the past couple of years, in fact, as we all know, we and have experienced from 2.5% in January of 2023. And I realize that the chart here is a little bit skewed due to some of the formatting. Please bear with me. But from January 2023, where it was at 2.5% to a projected 3.6% by March of 2025. This steady increase in inflation is eroding people's purchasing power, meaning their money doesn't go as far as it used to. And not only the purchasing power, when people are saving those dollars in savings accounts and the rate of inflation is higher than the yield that you can gain on personal savings account, that could realize no growth or negative growth. Investors and individuals really need to be thoughtful about that because that weakening of your buying power essentially was eroding away at your wealth. To address this, individuals and businesses will need to do a strategic investment planning to maintain their standard of living and profitability. The chart on this slide, as I mentioned, shows the estimated inflation rates over this time period so we can see the gradual but consistent rise. So it's important for everyone to be aware of these inflation trends and plan accordingly, whether that's just adjusting budgets in the how because of the cost of living that's happening upon us, or it's investing strategies, how we adjust there. Those are really important things. And when we start to move into how this impacts real estate, I really want people to understand what is going on when it comes to the real estate marketplace. And we'll start mainly looking at what's going on specifically within residential housing. So everyone knows that mortgage rates remain substantially higher than what they were on average during the pandemic, when rates were 2%, mid 2%, low 3%, and not really reaching for most borrowers above 4 or 5%. And many homeowners took the chance to refinance during that time or purchase homes during those times. They're not motivated at all to purchase new homes because of the low interest rates they have on their current home. Interest rates were lowering. However, the Federal Reserve is cautiously managing them in this inflationary environment to make sure that they can stave off that rising inflation and keep it in the target rates that they want to be able to maintain it. Mortgage rates have been steadily rising, currently sitting at 6.83% as of April 17th of 2025. But this increase in rates has had a significant impact on housing affordability. One of the reports that I used to prepare this presentation was a report from Redfin. And according to Redfin, the median home sale price in the United States as of March of 2025 is $431,000 and 57, and reflecting a 2.5% year over year increase. So if we take these numbers, in particular on a $400,000 loan, the monthly payment is now $2,620, which is a 42% increase compared to just 5 years ago. So the higher mortgage cost means that the income required to afford a home has also gone up substantially. This is making it increasingly difficult for many potential home buyers to enter the market. Folks that have been diligently saving, folks that have been maybe trying to relocate to certain areas. Maybe they want to be closer to where they grew up, or maybe they just moved for a job and they've been taking advantage of some things, whether they have corporate relocation or not. The cost to acquire that home at this point in time, with the combination of the rates and the cost of the home itself, it is very expensive. And so this is making it increasingly difficult for these folks to be able to enter as buyers into the housing market. And one other note that I found really interesting from the same Redfin report cited that 27% of American families cannot afford to buy a home based on income requirements, which, if you think about it and how I'll connect the dots here, this is one of the foundational things that makes multifamily an affordable option for an essential need, which is that roof over one's head. So we'll dive into that a little bit more in a moment, but let's talk a little bit about navigating tariffs and these geopolitical tensions that are going on. We have wars in Ukraine and in Palestine and Sudan. We have famine running, and we have in our geopolitical world, we have tariff escalations that have led to, at this point, from my latest read, at the time when I created this presentation, that led to 245% increase on Chinese imports. Although I hear there may be some adjustments to that coming, but that's the latest report that I had, 245% increase on Chinese imports, creating significant challenges for businesses and for us as consumers who are going to bear the cost as those costs that businesses take on to bring in the products are going to get passed on to all of us as consumers. So this is going to have a substantial impact on everyone from a cost of living perspective. These geopolitical instabilities, such as energy and supply disruption, is adding further uncertainty and risk to global supply chains. Supply chain disruptions are having major impacts on manufacturing and retail, leading to economic uncertainty and slower GDP growth. These supply chain disruptions, in addition to the tariffs and the impact on the cost, when you think about those tariffs being passed on for our neighbors to the north in Canada and down into the south in Mexico, our European brothers and sisters, all of us we're bearing the brunt of the cost of those materials coming into the marketplace. So think about people that are trying to develop new construction homes, or maybe appliances that are coming from overseas, were planned at a certain price, and to build development now have been increased substantially as a result of these tariffs that have been implemented. So navigating these complex issues requires a strategic, proactive approach to minimize the impacts on your business. And I couldn't think of a better person to look to when we think about real estate investing than Warren Buffett, because at this time, with all of what I just shared to open the presentation, one would have to ask themselves, is it wise to at all to be investing at this point in time? I would argue Warren Buffett has some really great information here. And he has a quote that he's famously known for, and he reminds us to take a contrarian approach and invest when others are fearful. So, the quote, if you will, that he talks about here is be greedy when others are fearful, and fearful when others are greedy. So, current market volatility and economic uncertainty have created opportunities for strategic real estate investment. Real estate can serve as a shield against all of this economic turmoil, providing stability and long term growth potential. And what I want to be able to do over the next few slides is talk a little bit about how to identify the right real estate investments to capitalize on this market environment. I'll also talk a little bit about what we do at Boost Capital Group to help navigate through those things, and what if you're working with other sponsors or evaluating other deals or putting together your own deals, some tips and things that you should be looking at to be able to help you position yourself to be successful in this environment, to take this contrarian point of view and be greedy when others are fearful. And real estate actually has historically performed well during periods of high inflation and economic instability. Think about when a lot of people built their wealth during the great financial crisis in 2008, when everyone else was running away and selling and looking at the sky falling. There were very savvy investors that were paying attention to what was going on and looking at the fundamentals and the data and realizing the opportunity in that. And that's something that we all need to be thinking about in this time. And I'm not suggesting at all that this is a 2008 situation, but I am suggesting that there are opportunities that people need to consider to be able to position themselves successfully in 2025. And so by taking a disciplined, value-oriented approach, we can find attractive real estate assets that can weather the storm. So let's talk a little bit about this real estate, and in particular, how it can be a shield against economic turmoil. So with everything going on in the world right now, as I mentioned before, why does investing in real estate make sense? Real estate is a tangible asset that retains its value even during economic turmoil. And investing in real estate provides steady, consistent cash flow through rental income. So again, as I stressed earlier, people need a roof over their head. And rightly or wrongly, I talk about this often, whether people have to make a decision between paying for their prescription medicine or paying their rent. People are going to leave that medicine at the pharmacy to be able to afford and pay for their rent. And I'm not at all suggesting that this is a right or wrong thing. I'm just suggesting that people make decisions in these things, and that roof over one's head, that apartment comp that they have, is something that's essential that they need. And and therefore that also contributes to the cash flow that comes that the property produces and gets passed on to you as an investor, as a well. And over the long term, real estate tends to appreciate in value, offering potential for growth. And as inflation rises, rents can also increase, making a real estate an effective hedge against inflation. So raising the rents to keep pace with inflation is something that's very beneficial from a real estate perspective, and not many other investments can do that. And these are some of the key attributes that make real estate an attractive investment option, especially during uncertain economic times. So let's talk a little bit about some of the 2025 US multifamily real estate trends. And so the multifamily real estate market is seeing some key trends emerge in 2025. And it's important for us as we're being being those contrarian investors and recognizing, understanding what opportunities exist in the marketplace, whether it's a market or a down market, we need to be informed about what's going on here. So let's get into that. So construction starts, meaning the number of new buildings being built. Those are down 30% from pre-pandemic levels, creating a more balanced market. So why is that important? So during, of course, there's a lot of population growth and job growth and demand for housing in some of these key markets. And many developers were following that demand and those opportunities and developing multifamily housing in those markets to be able to service the demand. And during that time, there was in some instances, surplus of housing units were being delivered, and not all of them were being absorbed, or if they were being absorbed, but perhaps not the clip they were. But then for existing assets that were in the marketplace, when new entries come in, that those new properties present competition essentially that then potentially erodes away your tenant base, your pricing from a rental perspective. So all of those things are really important. But the fact that they're down 30%, and by the way, before I go there, developers were doing that because again, they can get cheap debt during that time to then develop these properties. We didn't have tariff wars with steel and lumber coming in from our neighbors to the north and south or from China. And people were able to develop these units and build them profitably and also service a need within those particular communities. I also talked a little bit earlier how high home ownership costs are driving sustained rental demand across major metros. If people cannot buy a home, as I stated earlier and as read and reported, people still have that universal need to have a roof over their head. And so what we're talking about here is being able to serve a need. And when we think about multifamily, those multifamily apartment complexes certainly do serve a need in the communities where there's high demand across these major metros for tenants to be able to live, and therefore for operating and investors to be able to take advantage of these opportunities where tenants are seeking to be. Rent growth is stabilizing at 2.6%, and vacancy rates are declining to 4.9%, which is also important. However, there is some regional variance with the Midwest outperforming, while some Sunbelt markets, think about places from the Carolinas through Texas and Arizona as an example, Nevada. Some of these Sunbelt markets face temporary oversupply challenges. As I mentioned, those are some of the key places where the demand for housing has been substantial, continues to be over the past several years. But because the money and high development went into those areas, we saw a lot situation where there was some oversupply. And so that again is causing a lot of competition, and people need to be mindful of those things and how that's impacting their investment. But now a lot of this is changing as those units are being absorbed. There's no new supply coming online in the near future for a while, given the cost of that debt that we talked about with higher interest rates, and given the cost of now materials when it comes to the inflation, or excuse me, the tariffs that are being applied to materials that are required to develop new construction. So for many development deals, there's not a lot of opportunity there, or if there is, they really have to be creative in terms of how these deals, anything new gets funded. And so despite capital market headwinds, investor confidence remains strong, with multifamily continuing to be a top asset class. Because again, a lot of other moving parts are speculative. We need to be thinking about asset classes, what makes sense. Does it, when we think about this marketplace, what about retail? If retailers are going to be impacted by tariffs potentially, is that a good space to be in? Industrial, if imports are slowing down because a result of these policy changes that we have, and industrial parks are not being able to generate the revenue that they projected, how does that impact things. So these are really important considerations. And the list goes on, but my point, we really want to be thoughtful about how we approach these things. So when we invest, we also want to know, how will I get my money back? This is really important. And so the investment cycle diagram that I have here illustrates the key stages of how investors can get their money back from a real estate investment in particular. So this is the simplified version, if you will, but think about acquisition as the first step, where the property is purchased and funds are wired and allocated into particular deal. And after all of the logistics and things that get executed from there, sponsors begin to execute the value added business plan, implementing strategic improvements to increase the property's income and reduce the expenses, overall improving the performance of the asset. And as they're doing that, they are working on improving the process, improving the property, that cash flow that it needs to generate from not only the rental income, but also other income that is generated in the form of parking fees, pet fees, laundry fees, the gym facility. We garbage services, those types of things are all different ways in which other ways that we can help to maximize the profitability of the asset over time. And then those distributions of income that the property generates to investors, monthly or quarterly distributions from that property. And over time, the property will, done correctly, meaning that it's bought right, protected, managed right, and it was financed right, then we're going to be in a situation where the property is naturally appreciating in value from being real estate in a prime market, but also we're forcing appreciation through value add improvements that we are executing, and the property will, as it appreciates, that provides another way for investors to recoup their investment, and oftentimes an upside to that investment deal where they're able to gather some of the additional proceeds from the sale or refinance of the property, which is that final step when we exit the deal. After that 3 to 5 year time frame, there'll be an exit event that takes place in that investment opportunity through a sale or refinance, as I mentioned before, and investors will be able to take those proceeds and work through leveraging for other investments or other things that they're interested in doing. But this cycle, again, high level, demonstrates the different ways that investors can generate a return on their investment from a real estate perspective. And I did not even cover the tax benefits that come with investing in real estate, which I'll touch on a little bit later. But as we navigate common passive investing challenges here, you have to understand that passive investing requires a long-term commitment, as the assets are generally less liquid than actively traded investments on the stock market. That's the fundamental things. I always tell investors, when you are committing to these deals, you'll realize that they're typically, the whole period's about 3 to 5 years. So make sure that this money that you're putting forth is money that you're okay with being invested for that time period. If not, then you need to be looking at other investments that meet your criteria. And with passive investing in particular, management of these assets is entrusted to the operators. So investors have less direct control over the investment. You get to be hands off and have to worry about the day-to-day aspects of things, because you're entrusting in the pros to do what they need to do to successfully operate the proper property and deliver a return for you. And many investors are concerned about the timing of entering passive investment, and they may be buying on a market peak. And so timing the market is always a very challenging thing. And you want to be able to invest as a savvy investor, invest when markets are up and down. So it's not necessarily about timing the market. If you focus on the core fundamentals and you have a good investment in front of, whether the market is up or down, you should position yourself in a solid way. if you're chasing markets. And I always think about when I was in college, I had a buddy whose parents relocated from New York to Las Vegas because that's where all the money was going. And there were so many people going there and they were making money hand over fist flipping houses. And then all of a sudden the bottom fell out from these crazy subprime loans that were taking place down in that time. And they were chasing the appreciation and the fast money and not necessarily focusing on the fundamentals. And these are things that people need to be mindful of. And what I talked about before, when I started this, I wanted to share some of the things that what we're doing at Boost Capital Group to help us position our investors in the best real estate deals. And these are things that you'll want to be able to consider for yourself as you are working with other operators or you are focusing on doing your own deals. Be sure to be thinking about things in the way that I'm going to share here. The goal really of this slide is to highlight what our rigorous due diligence process that protects investor capital. So first and foremost, we have a very thorough 200 plus point due diligence checklist. We start by really understanding the markets that we focus on, and we carefully analyze what's going on. What is the job growth? What is the population growth? What is the demand for housing? What are the rental rates? What are the different financial metrics, the cap rates? What about the operating partner that we're working with? All of these things are part of it. Then we start to look at the financial modeling. We stress test our projections and capital needs to make sure that the investment can withstand potential downturns in volatile markets. Even as things swing, as stable as real estate can be, I think one of the things that the pandemic taught us and investing through that time is that even in that time, folks need to be thoughtful about the types of investments that they're getting into, and really thinking about the types of financing that they're doing, how long they're planning on holding property, the business plan that they're planning on executing. These are all really important things to be able to help position yourself. And finally, we emphasize our team's experience and trusted partnerships we've built with top tier operators who are the best of the best in this space. And so we really rely on our experience as capital allocators, fund managers, to be able to help position our investors in favorable spots. And so I want you to be able to understand how this all comes together and really recognize that due diligence, if you're a real estate investor, and the level of due diligence that is done on the deal, going to help you really ensure that you are positioning yourself in the right way. It's not like your cousin giving you a stock tip on what to go buy out there, and you're just going off of loose information. This is real stuff, thorough level research, in depth, that takes weeks and sometimes months of time to be able to make a decision on whether we're going to move forward with an asset or whether or not we need to pass on an asset because it's not right for us and our investors. So diversifying your portfolio is key to mitigating risk and achieving long-term investment. So having experienced management teams overseeing your investment provides an additional layer of risk mitigation. Investing across multiple property types such as commercial, multifamily, self-storage, private lending, and industrial helps diversify your asset class exposure. Focusing on high growth and low risk markets for your real estate investments can further diversify geographic footprint and reduce overall risk. And by implementing these diversification strategies, you can build a more resilient and balanced portfolio, because most of us are heavily invested in the financial markets, meaning all of our wealth and our ups and our downs are tied to, in some way, ebbs and flows of the stock market, whether that is your 401k or whether that is your personal Robinhood or Vanguard account or Fidelity account, or maybe you have some TD Ameritrade or whatever the case may be. Most people have everything tied up in the financial markets, and the wisdom of that needs to be considered. When we talk about diversification, we want to make sure that we're not putting all of our eggs in one basket, and that we have really solid allocation. Yes, we want some market exposure, but we also want to make sure that we're exposed to alternative investments, and real estate in particular provides great opportunities. So really make sure that you're on top of that. And when it comes to your investment strategy, we recognize that investors want to be able to have personalized investment strategies that are tailored to you and that's important. So what we have from and one of the things that you want to be considering when you're looking at partners to invest with, I like to share what we do because then that helps you compare when you are out there looking in the marketplace for potential places to park capital to invest in alts. You'll be able to understand what other things exist out there. And so we give our investors the ability to create a custom investment plan based on their unique goals and timelines. And this ensures that ultimately their portfolio is aligned with what's most important to. We also provide you with the ability to conduct regular strategic reviews of your portfolio in the portal to assess performance and make any necessary adjustments. And this allows you to proactively manage your investments that you have within the fund and within the portal. And so we pride ourselves in making sure that we have transparent communication. So this is key. You want to make sure that anyone that you're working with also is providing you with transparency when it comes to communication. So we're making sure that they're providing you with regular updates because that's what we do. We provide regular updates, to monthly or quarterly updates and detailed reports so that you can always be informed about the status of your investments and how things are going. And our goal is to provide you with a personalized investment experience that gives you confidence in your strategy when it comes in your future when it comes to investing in alternative investments. And you want to make sure that anyone else that you're investing with, they are helping you do the same. So why passive investing? Passive investing, from my perspective, in real estate, it provides steady stream of income without the need for active management. It helps diversify your portfolio and reduce overall volatility. There are numerous tax advantages, as I mentioned earlier, that can boost your returns, like deductions for depreciation and mortgage interest, example. And over the long term, real estate has strong potential for appreciation, allowing you to build wealth, which we talked a little bit about earlier. When we think about exploring passive investment strategies, real estate, there's really a few different things that we can talk about here. Where we focus on are particular are real estate syndications and funds. So just to give you a little bit of definition, because many people are not familiar with real estate syndications and funds, all what this is that it allows you to pool your money together with other investors to invest in specific properties. So that apartment complex around the corner from where you live, there's a good chance that a group of investors were brought together, pooled their money together by some operating partners, pooled their money together to acquire a building and then pass on all the returns to the investors. And what you get from that, from when you invest in a syndication or fund, you actually get direct ownership in specific properties. There is a typically higher minimum investment for you to get into these things, which is one barrier for investors that they may have. But this provides cash flow, tax benefits, that ownership of the property without having to do any of the heavy lifting. When we look at the other assets here from a real estate perspective, what you need to know, one of the questions that I get often is, oh, so that real investing in a syndication or fund is like a REIT. And I have to explain that, no, it's not. REITs are publicly traded real estate companies that provide exposure to real estate, but are correlated to the stock market. And REITs offer high liquidity and lower investment minimums, but they have less favorable tax advantages compared to direct property ownership. And when we think about crowdfunding platforms that are out there, and everyone has more or less seen those, clicked around the internet a little bit. These are these opportunities to invest in real estate through different online offerings, which they offer lower minimums and they often start around $5,000. I think even Grant Cardone and Cardone Capital has done something along those lines that allow people to get into these types of investment at a much larger level. So these platforms provide access to a variety of property types, but I wanted to again make sure that you understand that these different types. This is not exhaustive, of course, but real estate syndications provide some unique considerations here as people are thinking about diving in. And then when we're thinking about leveraging tax benefits from real estate investors, one of the most people know that real estate investors can take advantage of various tax benefits to maximize their returns. So one key benefit is depreciation, which allows you to write off the value of your investment property over time. Another powerful strategy that people are able to take advantage of in real estate is the 1031 exchange, which lets you defer capital gains taxes when selling an investment property and reinvesting those proceeds. There's also something that is called a cost aggregation. So depending on what happens in from a policy perspective and laws that are being worked on right now from the current president's tax proposals, these next two things that I'm talking about could be very substantially favorable for people who invest in real estate in particular. Cost segregation can help accelerate your depreciation deductions by breaking down your property into components with shorter useful life. We can also talk about the fact that finally, pass-through deduction provides a 20% at this point deduction on qualified business income from rental real estate. But you'll talk to your CPA and tax professionals about that to make sure that you're positioned in the right situation, of course. I also want to talk a little bit about investing in real estate passively using your retirement account. So many people don't know this, but they can invest in real estate with their retirement accounts. And traditional retirement accounts, they are typically limited to stocks and bonds and mutual funds. And those things, as we've previously discussed, are all exposed to market volatility. You have less control over the investments and lower potential returns and standardized options. Then there's self-directed accounts, however, and whether it's a self-directed IRA for tax advantage growth or a solo 401k, people can have access to as well. You can roll your eligible funds into one of these self-directed accounts, and you can then take those retirement dollars that are exposed entirely to the market and now expose them to alternative investments and help you grow and protect your wealth that way. And that has been a game changer for many people. And one of the tools that I use is the EQRP Solo 401k that allows me to be able to expose some of my retirement dollars to real estate in particular. So the benefits of these things is helping you maximize your retirement savings through real estate, getting that tax deferred or tax free appreciation, being able to diversify your portfolio. I cannot stress this enough. And all of that cash flow and the income goes into your retirement account for your future self to take advantage of in the future, just as though as if it was exposed to a syndication, or excuse me, a mutual fund on the market. It's for you for your future. And so this is the only difference, is that it's just being exposed to alternative investments instead of what's publicly traded on the markets. And so this cash flow diagram on this slide illustrates the key component of managing cash flow for long-term success in real estate investments. And so initial investments refers to the capital contribution required to acquire the property. And then we talk about the income generation that happens from the rental income, as I talked about before. So this is the property earnings minus any of the operating expenses. Then the distributions go out, that represents monthly or quarterly payments to the investors that were in on the deal. And then, that reinvestment involves strategically investing capital improvements to drive future growth of the property. And so understanding and effectively managing these cash flow components is crucial for long-term success in real estate investing. So I talked about a ton of the benefit of investing in real estate. but there are also so many risks to look out for. And so I wanted to talk a little bit about some of those risks to really help position you for success. These are some of the things that we look for when we for at Boost Capital Group when we're looking at investment. So we look at market selection risks. Are we investing in the right place? If we are in the wrong, you all have heard the saying before, location. If you're in the wrong spot, that could be one of the things detrimental to your investment. And so we want to make sure that we're selecting the right markets. Vacancy. If we don't have enough demand for our housing, then the units will stay vacant and that will negatively impact income that we can generate from the rental income on the properties. We focus on being in markets that are growing, where there is a high demand for that housing, and the demand factors are in our favor. As an example, we look at the management risk. And what do I mean by that? We are looking opportunities where we recognize that inexperienced management teams can damage the performance. You can have the best asset in the best market, but if it's not managed right, you may put yourself in a poor position. And we focus on partnering with proven, experienced operators with track record of success. And then finally, from a financial risk perspective, in particular, the property, how much debt, how much equity is being put forward to acquire the asset, how is it structured, what type of loan product is it? All of those things are really important. And so we pay very close attention to the financing, whether it's done conservatively or how are the terms and the structure of the deal. All of those things are important for us and what we think about at Boost Capital Group to make sure that we're proactively mitigating risk to protect your investments and maximize return. Have taken you through a number of things. And what I want to make sure that you can understand now is that as you're on your journey, whether you're looking at opportunities out there to learn about passive real estate investing, and whether that is with folks like us at Boost Capital Group, or you're looking at other operators out there as you're evaluating different deals, the journey to building wealth through multifamily investing really starts with four key steps. And the first thing is that it's important to get educated on the fundamentals of multifamily investing and learning about the market, the strategies, and the potential returns. And then after that, you want to be looking at research the different, if you will, the different investment vehicles available, whether that's crowdfunding or platforms, private equity funds. What we're talking about here are direct property ownership and the syndications or fund of funds structures. Those are all things, and you want to be able to evaluate the pros and cons of each of those options for where you are in your investment journey today. Once you've done your homework, the next step is to select that experienced operating partner who can help guide you through the investment process, and look for a track record of success, and consult your professionals, your tax and legal and business professionals and advisors to be able to help guide you through this process, and alongside of the operating partner to help you see what that and evaluate those opportunities so that they can really help you understand how this positions your portfolio in a solid way. And finally, when you're ready, you go ahead and take those steps and you fund your investment account and make your initial capital contribution. And that basically helps to kickstart your journey to building a multifamily real estate portfolio. And I hope that you all can really take a strong look in consideration at this asset class. There's a ton of potential that's there, a lot of real opportunities for folks to be able to diversify their portfolios and lessen the exposure from the volatility in the marketplace, and helping you recession proof your retirement. So with that, I want to thank everybody for their time this evening. If you want to reach me, you can email me at chris@boostmycapital.com. I want to also guide you to our website, www.boostcapitalgroup.com. Find us online. Feel free to look at our blogs, and we have a ton of resources and information there for you to keep your learning going. And I can't wait to meet you and talk to you about your investment needs. Thank you very much and have a great evening.